Hey everybody, so today I wanted to address this question that came from one of the members of this Facebook group. It's called the First Time Homebuyers Facebook group. If you haven't joined, you should probably join. There's a lot of folks asking questions as well as folks like myself answering questions. But let's take a look at this question. Basically what she's asking is, where should she start? How much can they afford? So let's read here. It says, what amount could my husband and I possibly be approved for? I make $22 an hour. My husband makes $20 an hour. We have no debt besides our credit cards, which is about $400 a month, and our credit scores are around 700. I want to make the jump into buying a house, but don't know where to start or even if it's worth it. This is a great question. So let's start from the basics of trying to figure out, what her affordability is. So I'm going to just go quickly to my affordability calculator over here, and let's take a look here. So she says she makes $22 an hour. Her husband makes $20 an hour. So that's $42 combined. So I'm going to do $42 times 40 hours a week. All right. And that's going to come out to be about $1,680 total for the both of them. So $1,680 total per week gross pay equals about $7,280 a month. That's combined. So with that, right now, before tax and insurance or any of the debt, they can afford about $3,276. This front and back DTI, debt to income ratio, it varies based on investors and your scenario. It can be capped at 40%, 42, 49.99, depending. I'm just going to keep it here right in the smack dab middle at 45 just to be safe for now. But we can always adjust it 49 or 40 or whatever based on the investor, the lender that you're going to be working with. So she did say that she has $400 in credit card debt. So let's add that in there. And then this leaves about, let's see here, max qualification of loan amount is about $492, but I would never recommend somebody that's making $7,280 to use half of their income almost for mortgage. So let's go here at this the safe estimate of about 25% of their income or their gross income. So for that amount, I'm going to say 18, 20. I think that's about a $300,000 home-ish. So for a $300,000 home in Montgomery County for a townhome, we're looking at about property tax of about $200. And I'm going to say, I think homeowners insurance is about $100 a month. And then for a townhome, because there's not going to be that many single family homes in Montgomery County for $300,000. So for a townhome, you're looking at about probably a homeowner's insurance of right around $100, $150. So just to be conservative, I'm going to say $150. All right. So tax and insurance, and I added HOA as well. So that leaves us with right here minus maximum affordability of $2,426. But then let's take a look at, the mortgage should be right around 25%. So, they're going to be looking at a mortgage for right now, par rate, no points or no lender credit is about 5.75 as of this recording, APR 5.81. And the mortgage terms, this is for a 30-year fix. So this person should be looking at a loan amount of about $234,000 to about $415,000. That's the range you should be looking at. Now, so that's going to be loan, and this is going to be the payment range before your tax and insurance, okay? Because if you look here, this is minus the tax and insurance. So $1,370 plus the $450 or $2,426 plus the $450, okay? For your total housing expense. Now from here, what you want to do is you want to do some reverse math. I hope you remember some of your arithmetic. So a first-time home buyer, if you do qualify, then the minimum down payment for a conventional loan is going to be 3% down. FHA is 3.5%, VA is 0%, as well as USDA if that's somewhere that you're looking into agriculture. It's very specific in terms of what you can purchase. But let's just take a look at conventional loan, 3% down. So if we pull up the calculator, we'll see here, if you remember your arithmetic, then it's 276. If it's 3%, you have to divide by 100 minus 3, which is 97. And so your purchase price is $242,000. All right. So that means 3% of 242 is $7,260. Now from there, you have to consider your closing cost. If you're not going to get any seller concession, and you probably also want to budget in a little bit of like moving expense and things like that. So $726. And I'm going to say that you should budget probably another 2 to 4%. So another 3% for closing costs. So if you multiply this by 2, you're looking at a closing cost or total cash to close with closing costs as well as down payment of about $14,500 for a $242,000 home. That's kind of what you should be budgeting and targeting for if you're looking to buy a home where you're earning $22 an hour plus $20 an hour for your husband. Okay. So if there's any questions, let me know, comment below. I hope this was helpful for you to kind of understand how the process works in order to kind of figure out what you can afford. Of course, there's the FHA where, you have to put 3.5% down, but there's also a higher PMI. There's an upfront MIP that you have to go into. There's obviously 5%, 10%, 20%, all that stuff that you can consider. But of course, for this scenario, this person, it kind of looks like, they haven't started preparing to buy a home. So maybe they have some savings and they're trying to figure out how to use it, or maybe they haven't saved anything and they want a goal and a target to kind of start saving towards. So this gives you a ballpark idea of about $14,500-ish, right? That's comfortable for a $250,000 home. Right around, that's what you're going to be targeting for if you're earning $22 an hour and $20 an hour combined. Okay. So hope this was helpful. If there's any questions, comment below. If there's a scenario that you want me to walk you through, then let me know as well. All right. Have a great and blessed day.